Before we dive in, let me take just 1 minute to explain exactly what you're going to get in this video. First, we'll go through the complete background of Bitcoin, from its early idea to the key milestones that changed the market. Then, we'll connect that history to something really powerful: funded accounts. What they are, how you can use them to trade crypto, and how they allow you to start small but manage larger capital. After that, we'll move into the practical side: proven strategies to pass challenges, clear risk management rules, common mistakes you should avoid, and even real-life examples and stories. Finally, we'll take a look at the future of funded accounts and their impact on the crypto world. So if you're serious about learning, stay until the end. Hit the like button, subscribe, and turn on the notification bell. And if you want, drop a comment telling me if you'd like me to compare the top funded account companies in another video.
The birth of Bitcoin, a digital revolution. In the wake of the 2008 financial crisis, a revolutionary idea was born. An anonymous figure known as Satoshi Nakamoto introduced Bitcoin to the world. It was October 31st, 2008. Nakamoto published a white paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. This document laid out the blueprint for a new type of money. It was digital, decentralized, and independent of any central authority. Bitcoin was designed to solve several problems with traditional currencies. It aimed to eliminate the need for trusted third parties in financial transactions. It also sought to prevent double spending in digital cash systems. The concept was radical. It promised a way to transfer value directly between parties. No banks or governments would be needed as intermediaries. The timing of Bitcoin's introduction was significant. Trust in financial institutions was at an all-time low. The global economy was reeling from the effects of the financial crisis. People were looking for alternatives to the traditional banking system. Bitcoin offered a potential solution. It promised a currency that couldn't be manipulated by central banks or governments. However, at this stage, Bitcoin was just an idea on paper. It would take more than 2 months for this concept to become a reality. The journey from white paper to working system was about to begin. The world was on the brink of a financial revolution. Few could have predicted the impact this new digital currency would have in the years to come. Early years, from white paper to reality. On January 3, 2009, the Bitcoin network came to life. Satoshi Nakamoto mined the first block of the Bitcoin blockchain. This block, known as the Genesis block, contained a message. It read, "The Times 03 Jan 2009 Chancellor on brink of second bailout for banks." This message served as both a timestamp and a statement of purpose. It highlighted the economic context that gave birth to Bitcoin. The first Bitcoin transaction took place on January 12, 2009. Satoshi Nakamoto sent 10 BTC to Hal Finney, a cryptographer and early Bitcoin supporter. This transaction marked the beginning of Bitcoin as a functioning currency. It proved that the system outlined in the white paper could work in practice. These early days were crucial for testing and refining the Bitcoin software. As word spread about this new digital currency, a small community began to form. Developers, cryptographers, and libertarians were among the first to show interest. They saw potential in Bitcoin's promise of financial freedom. Early adopters began mining Bitcoin on their personal computers. At this time, mining was relatively easy and could be done with basic hardware. The first real-world transaction using Bitcoin occurred in May 2010. A programmer named Laszlo Hanyecz bought 2 pizzas for 10,000 BTC. At the time, this amount was worth about $41. Today, those same 10,000 BTC would be worth millions of dollars. This transaction, now known as Bitcoin Pizza Day, is celebrated annually by the Bitcoin community. It serves as a reminder of how far Bitcoin has come since its early days. Milestones and major events 2008 to 2021. Bitcoin's journey from 2008 to 2021 was marked by numerous significant events. In 2011, Bitcoin reached parity with the US dollar for the first time. 1 BTC was now worth $1. This milestone brought increased attention to the cryptocurrency. The same year saw the launch of rival cryptocurrencies, often referred to as altcoins. These included Litecoin and Namecoin. 2013 was a year of explosive growth for Bitcoin. The price surged from around $13 at the start of the year to over $1,000 by November. This rapid increase caught the attention of mainstream media and investors. However, it also led to increased scrutiny from regulators. The same year, the first Bitcoin ATM was installed in Vancouver, Canada. This made it easier for people to buy and sell Bitcoin. The years 2014 and 2015 were challenging for Bitcoin. The collapse of Mt. Gox, once the largest Bitcoin exchange, shook confidence in the cryptocurrency. The price of Bitcoin fell and remained relatively low for most of 2015. However, this period also saw increased interest from the traditional financial sector. Major banks began exploring blockchain technology. From 2016 onwards, Bitcoin entered a new phase of growth and maturity. In 2017, the price of Bitcoin reached new heights, peaking at nearly $20,000. This bull run brought Bitcoin into the mainstream spotlight. 2020 and 2021 saw increased institutional adoption of Bitcoin. Companies like Tesla and MicroStrategy added Bitcoin to their balance sheets. In 2021, El Salvador became the first country to adopt Bitcoin as legal tender. These events marked Bitcoin's transition from a fringe technology to a recognized asset class. Blockchain, the technology behind Bitcoin. At the heart of Bitcoin lies the blockchain, a revolutionary technology that powers the entire system. The blockchain is essentially a digital ledger. It records all Bitcoin transactions in a secure, transparent, and immutable way. This technology solves the double spending problem that had plagued previous attempts at digital currencies. It ensures that each Bitcoin can only be spent once. The blockchain is composed of a series of blocks. Each block contains a set of Bitcoin transactions. These blocks are linked together in chronological order, forming a chain. Hence the name blockchain. When a new transaction occurs, it is broadcast to the network. Miners then work to include this transaction in the next block. Once a block is added to the chain, it cannot be altered without redoing all the work that came after it. One of the key features of the blockchain is its decentralized nature. There is no central authority controlling the Bitcoin blockchain. Instead, it is maintained by a network of computers spread across the globe. This decentralization makes the system highly resistant to censorship and control. It also means that the blockchain is transparent. Anyone can view the entire history of Bitcoin transactions. The blockchain technology introduced by Bitcoin has applications far beyond cryptocurrency. Industries from finance to healthcare are exploring ways to use blockchain. Its ability to create secure, transparent, and immutable records has wide-ranging potential. Some see blockchain as the foundation for a new, decentralized internet. Others view it as a tool for creating more efficient and transparent business processes. The full potential of blockchain technology is still being discovered and developed. Section 5. Mining, powering the Bitcoin network. Mining is the process that keeps the Bitcoin network running and secure. It serves two primary purposes. First, it adds new transactions to the blockchain. Second, it introduces new Bitcoins into circulation. Miners are essentially the auditors of the Bitcoin network. They verify and record transactions on the blockchain. In return for their work, miners are rewarded with newly created Bitcoins. The mining process involves solving complex mathematical problems. Miners use powerful computers to find a solution to these problems. This process is known as proof of work. It ensures that adding new blocks to the blockchain requires significant computational effort. This makes it extremely difficult and costly to tamper with the blockchain. The first miner to solve the problem gets to add the next block to the chain. They also receive the block reward. When Bitcoin first launched, mining could be done on ordinary personal computers. However, as Bitcoin grew in popularity and value, mining became more competitive. This led to the development of specialized mining hardware. Today, most Bitcoin mining is done by large mining farms. These farms use application-specific integrated circuits, or ASICs, designed specifically for Bitcoin mining. This has made Bitcoin mining a capital-intensive industry. The Bitcoin protocol is designed to adjust the difficulty of mining. This ensures that new blocks are added to the chain at a steady rate. On average, a new block is added every 10 minutes. The block reward halves approximately every 4 years. This event is known as the halving. It ensures that the supply of new Bitcoins decreases over time. Eventually, no new Bitcoins will be created. At this point, miners will be rewarded solely through transaction fees. Section 6. Decentralization and limited supply key features. Decentralization is a core principle of Bitcoin. Unlike traditional currencies, Bitcoin is not controlled by any central authority. There is no government or central bank that can manipulate its supply or value. Instead, Bitcoin operates on a peer-to-peer network. This network is maintained by users around the world. This decentralization makes Bitcoin resistant to censorship and control. It also means that Bitcoin can operate 24/7, without the need for banking hours or holidays. The decentralized nature of Bitcoin extends to its development. While there is a core team of developers who maintain the Bitcoin software, anyone can propose changes. These proposals are discussed and debated by the community. Major changes require consensus from the network participants. This open development process ensures that Bitcoin remains true to its original principles. It also allows the system to evolve and improve over time. Another key feature of Bitcoin is its limited supply. Unlike fiat currencies, which can be printed at will by central banks, Bitcoin has a fixed supply. There will only ever be 21 million Bitcoins in existence. This limit is hard-coded into the Bitcoin protocol. As of 2021, about 18.5 million Bitcoins have been mined. The last Bitcoin is expected to be mined around the year 2140. This limited supply gives Bitcoin deflationary characteristics. As demand for Bitcoin increases, its value tends to rise. This is in contrast to fiat currencies, which typically lose value over time due to inflation. The limited supply also makes Bitcoin a potential store of value. Some compare it to digital gold. However, this limited supply also means that Bitcoin may not be suitable as a day-to-day currency. The potential for appreciation encourages holding rather than spending. Section 7. Price volatility, Bitcoin's wild ride. One of the most notable characteristics of Bitcoin has been its price volatility. The value of Bitcoin has experienced dramatic swings throughout its history. These fluctuations can occur over short periods, sometimes within hours. This volatility has been both a blessing and a curse for Bitcoin. It has attracted speculators looking for quick profits. However, it has also deterred some from using Bitcoin as a stable store of value or medium of exchange. Several factors contribute to Bitcoin's price volatility. The relatively small size of the Bitcoin market makes it susceptible to large price swings. A single large trade can significantly impact the price. News and events also play a crucial role. Regulatory announcements, security breaches at exchanges, and adoption by major companies can all cause price fluctuations. The speculative nature of many Bitcoin investments also adds to the volatility. Bitcoin's most dramatic price increase occurred in 2017. The price rose from about $1,000 at the start of the year to nearly $20,000 by December. This bull run brought Bitcoin into the mainstream spotlight. However, it was followed by a significant crash in 2018. The price fell to around $3,000 by the end of that year. This cycle of dramatic rises and falls has repeated several times in Bitcoin's history. Despite the volatility, Bitcoin's overall trend has been upward. Those who bought and held Bitcoin over long periods have seen significant returns. However, the volatility remains a challenge for Bitcoin's adoption as a currency. For Bitcoin to function effectively as a medium of exchange, its value needs to be more stable. Some argue that as the Bitcoin market matures and liquidity increases, volatility will decrease. Others believe that Bitcoin's volatility is an inherent feature of its design. Section 8. Regulatory challenges, navigating the legal landscape. As Bitcoin has grown in popularity and value, it has attracted increasing attention from regulators worldwide. The regulatory landscape for Bitcoin is complex and evolving. Different countries have taken vastly different approaches to Bitcoin regulation. Some have embraced it, while others have imposed strict restrictions or outright bans. This regulatory uncertainty poses a significant challenge for Bitcoin adoption and development. One of the primary concerns for regulators is the use of Bitcoin for illegal activities. The pseudonymous nature of Bitcoin transactions has made it attractive for money laundering and other illicit uses. Regulators are working to implement Know Your Customer (KYC) and anti-money laundering (AML) regulations for Bitcoin exchanges and services. These regulations aim to bring Bitcoin transactions under the same scrutiny as traditional financial transactions. Taxation is another major regulatory challenge for Bitcoin. Many countries have struggled with how to classify Bitcoin for tax purposes. Is it a currency, a commodity, or a new asset class entirely? The classification can have significant implications for how Bitcoin transactions are taxed. Some countries require detailed reporting of all Bitcoin transactions for tax purposes. This can be challenging given the pseudonymous nature of Bitcoin. The regulatory landscape is further complicated by Bitcoin's global nature. Bitcoin operates across borders, but regulations are typically set at the national level. This can lead to conflicts and inconsistencies. A transaction that is legal in one country may be illegal in another. Some argue that effective regulation of Bitcoin requires international cooperation. Others believe that attempts to regulate Bitcoin go against its fundamental principles of decentralization and freedom from government control. Section 9. Security concerns. Protecting digital assets. Security is a paramount concern in the Bitcoin ecosystem. While the Bitcoin network itself has proven to be highly secure, the same cannot always be said for the various services and applications built on top of it. Bitcoin exchanges, wallets, and other services have been frequent targets for hackers. These security breaches have resulted in the loss of millions of dollars worth of Bitcoin. One of the most infamous security incidents in Bitcoin's history was the Mt. Gox hack. Mt. Gox was once the largest Bitcoin exchange in the world. In 2014, it collapsed after losing 850,000 Bitcoins to hackers. This incident shook confidence in Bitcoin and led to increased calls for regulation. It also highlighted the importance of robust security measures for Bitcoin services. The security of individual Bitcoin holdings is also a concern. Unlike traditional bank accounts, there is no central authority to turn to if you lose access to your Bitcoin. If you lose your private keys, you lose your Bitcoin. This has led to stories of people desperately searching for old hard drives containing forgotten Bitcoin wallets. It has also spurred the development of more user-friendly and secure wallet solutions. Despite these challenges, the core Bitcoin protocol has remained secure. The decentralized nature of the network makes it extremely difficult to hack or manipulate. The energy required to attack the Bitcoin network makes such an attack economically unfeasible. However, as the value of Bitcoin increases, so does the incentive for potential attackers. This necessitates ongoing vigilance and improvement in Bitcoin security measures. Section 10. Institutional adoption. Bitcoin goes mainstream. In recent years, Bitcoin has seen increasing adoption by institutional investors and corporations. This marks a significant shift from Bitcoin's early days when it was primarily the domain of tech enthusiasts and libertarians. Major financial institutions that once dismissed Bitcoin are now offering Bitcoin-related services to their clients. This institutional adoption has lent legitimacy to Bitcoin and helped drive its price to new heights. One of the most notable examples of institutional adoption is MicroStrategy. In 2020, this business intelligence company began investing its treasury reserves in Bitcoin. By 2021, it had acquired billions of dollars worth of Bitcoin. Other companies followed suit. Tesla made headlines when it announced a $1.5 billion Bitcoin purchase in early 2021. These moves by public companies have paved the way for Bitcoin to be seen as a legitimate treasury reserve asset. Financial institutions have also embraced Bitcoin. PayPal and Square now allow users to buy and sell Bitcoin through their platforms. Major banks like JP Morgan, which once called Bitcoin a fraud, are now offering Bitcoin funds to wealthy clients. Goldman Sachs has restarted its cryptocurrency trading desk. These moves by established financial players have made it easier for both retail and institutional investors to gain exposure to Bitcoin. The rise of Bitcoin-focused investment products has further facilitated institutional adoption. Bitcoin futures are now traded on major exchanges like the Chicago Mercantile Exchange, CME. Several countries have approved Bitcoin exchange-traded funds, ETFs, allowing investors to gain exposure to Bitcoin without directly owning it. These developments have brought Bitcoin into the mainstream financial world. They have also increased the liquidity. Hey, before you click away, give me just 3 more minutes. If you've watched the full 18-minute history of Bitcoin and the 10-minute deep dive into funded crypto accounts, you're almost at the finish line of a 30-minute journey that could change how you see the entire crypto world. Trust me, this last stretch is worth it. Let's connect the dots. In the first video, I took you through Bitcoin's wild ride, from a mysterious white paper to global headlines. But here's what's easy to miss. Bitcoin didn't rise alone. It was the supportive accounts, the passionate communities, and the bold influencers who gave Bitcoin its backbone. They weren't just spectators. Believers, builders, storytellers, Think about it. Every time Bitcoin faced skepticism, it was these communities that rallied. Forums, Twitter threads, YouTube channels. People came together to share knowledge, troubleshoot, and honestly just hype each other up. That collective energy built trust in a technology that frankly sounded like science fiction at first. And that's the magic. Bitcoin's history isn't just about code and price charts, it's about people. Communities gave Bitcoin credibility when banks and governments wouldn't. They made it mainstream, one conversation at a time. Influencers helped millions take their first step, while supportive accounts kept everyone grounded and informed. Now, in the second video, I explored funded accounts, how they open doors for new traders and lower the barriers to entry. But here's the real connection. Those same communities are the driving force behind these opportunities. They're not just watching crypto evolve, they're shaping it. They're creating new ways for people to participate, learn, and grow. So if you want the full picture, don't stop now. Stick with me for these last few minutes and step into the world of funded accounts, where community power meets personal opportunity. Crypto isn't just a technology, it's a movement, and you're right in the middle of it. Ready to finish this journey? Let's dive in.
Hello, today we're going to talk about paid accounts. You have probably seen them everywhere online. Influencers' brands seem to grow overnight. They gain thousands of followers in a flash. It looks so easy, right? Many people whisper that the secret is a paid account. This idea is very appealing. It suggests you can buy your way to the top. But is it really that simple? Some of the things you hear are true. Many other things are just myths. These myths can cost you time, money, and even your reputation if you are not careful. This essay will guide you through the real story. We will use a simple myth versus reality structure. This approach will help you separate the facts from the fiction. We want to give you a clear and honest look at what paid accounts are. We will explore how they work. We will also show you the potential rewards and the hidden risks. Our goal is to empower you with the knowledge you need. This will help you make smart, informed decisions for your brand or personal profile. Forget the hype and the confusing jargon. Let's get to the simple truth. Understanding this topic is more important now than ever before. The digital world is crowded and noisy. Everyone is competing for attention. It is natural to look for a way to stand out from the crowd. Paid accounts offer a tempting solution. They promise to amplify your voice and get your message in front of more people fast. Let's uncover the 10-minute truth you truly need to hear about paid accounts. So what is a paid account? Let's make this really simple. A paid account isn't a special type of account you buy. Instead, it refers to using money to boost your existing online account. You pay a platform to get more visibility or unlock special features. Think of it like putting a small advertisement in a digital newspaper. Companies, creators, everyday people. They do it to reach more users than they would naturally. The core idea is simple. You spend money to get your content profile product in front of a larger, more targeted audience. You see examples of this every day. When you scroll through Instagram or Facebook, you see posts labeled sponsored or promoted. That is a paid account in action. A business paid the platform to show that post to you. In short, a paid account strategy involves using money to get extra reach, special features, a competitive edge online. The primary reason people use it is speed. Let's tackle the biggest myth first. Many people believe that if you spend money on ads, you will automatically become popular or famous. The thinking is that more money equals more followers. More followers equals success. This is a dangerous oversimplification. The reality is much more nuanced. Paid accounts can definitely increase your visibility. Your post or profile might be seen by thousands or even millions of people. But visibility is not the same as genuine engagement or loyalty. Just because someone sees your ad does not mean they will become a loyal fan. Think about it from your own experience. You see sponsored posts all the time. How many of them do you actually stop to look at? How many of those accounts do you follow? You only engage with content that is truly interesting. You only engage with content that is truly valuable. You only engage with content that is truly entertaining to you. The same is true for the audience you are trying to reach. You can force your content onto their screens, but you cannot force them to care. If your content is boring, low quality, or irrelevant to them, they will simply scroll past it. Paid reach without good content is like shouting into an empty room. Another common myth is a paid strategy that works on one platform will work everywhere. People often think, I'll just create one ad. Facebook, Instagram, TikTok, YouTube. This approach almost always leads to wasted money and poor results. The same ad looks good on a computer but is poorly cropped on a vertical phone screen. Each social media platform is its own unique ecosystem. It has its own culture, its own user demographics, and its own specific ad formats. What resonates with the professional audience on LinkedIn will likely fail with the younger, trend-driven audience on TikTok. The reality is you must tailor your approach for each platform. Instagram, TikTok, short, engaging videos, high-quality images. Your ad needs to be eye-catching and get to the point within the first 3 seconds. On the other hand, Facebook allows for longer text descriptions and direct links to a website. An ad there might focus more on storytelling or a detailed product description. The idea of a shortcut is very tempting, and many people view paid accounts this way. They believe it is a cheap and easy path to success that lets them skip the hard work of organic growth. The myth: throw a few dollars at a post, watch followers, and sales roll in, no effort. This could not be further from the truth. You can start with a small budget, but effective paid advertising is rarely cheap and it is not effortless. It requires constant monitoring, analysis, optimization. Costs can add up very quickly, and a poorly targeted campaign can burn hundreds or thousands of dollars. Think of initial spending as a budget for learning. Run small tests to find which images, headlines, audiences perform best. Many tests will fail. That's part of the process. Find the winners, scale those, stop the losers. This is anything but effortless. This is perhaps the most dangerous myth of all. In the quest for quick growth, many people assume that any service offering paid promotion is safe and legitimate. You can easily find websites and sellers online that make incredible promises. They might offer to sell you 10,000 followers for $50, or guarantee a certain number of likes on your posts. These offers seem too good to be true, and that is because they almost always are. The reality is that the internet is filled with scams and low-quality services that can do serious harm to your account and your reputation. The truth is that most of these cheap services use fake accounts, also known as bots. They are not real people who are genuinely interested in your content. They are computer programs designed to follow accounts or like posts. While this might temporarily inflate your follower count, it hurts you in the long run. Social media platforms have sophisticated algorithms that can detect this fake engagement. When they see it, they may penalize your account by drastically reducing the reach of your future posts. This means your real followers will not even see your content. In the worst-case scenario, the platform could suspend your account, or even permanently ban your account. Beyond the risk of being penalized, fake followers damage your credibility. Savvy users can easily spot an account with fake engagement. Now that we have busted some myths, let's build a simple, practical blueprint for setting up a paid campaign correctly. This process does not have to be complicated. Following a few clear steps can make all the difference between wasting money and achieving your goals. Step by step. Target, people, megaphone, money bag, chart. The first and most important step is to define your objective. What do you want to achieve with this ad? Do not just say more followers. Be specific. Do you want more people to visit your website? Do you want to generate sales for a specific product? Do you want to get more video views to build brand awareness? Second, you must know your audience intimately. Who are you trying to reach? The ad platforms have powerful targeting tools, but they are useless if you do not know who to target. Think beyond basic demographics like age and location. Age, location, what are their interests? Third, create compelling content specifically for the ad. Do not just boost a random post from your feed. Your ad content needs a clear message and a strong visual element. Finally, start with a small budget and track everything. In the digital world, being safe is just as important as being successful. When you start exploring paid promotion, you will encounter many offers. It is crucial to know how to distinguish the legitimate opportunities from the dangerous scams. The number one safety tip is simple. Only ever use the official advertising platforms. This means using the tools built directly into Facebook, Instagram, Google, TikTok. These systems are designed to be secure. Never, under any circumstances, should you give your account password to an unknown third-party website or service. One of the biggest red flags is a promise that sounds too good to be true. 10,000 real followers in 24 hours guaranteed viral success. Scammers prey on the desire for instant results. If you see a service promising impossible results, be extremely skeptical. Real advertising and audience growth do not come with guarantees. It is a process of testing and refinement. Another red flag is a lack of transparency. A reputable service or platform will provide you with a detailed dashboard and clear reports. Also, look for professional contact information and real customer reviews. Finally, always protect your payment information. In conclusion, paid accounts are a powerful and legitimate part of modern digital strategy. They offer the ability to reach a wider audience much faster than organic efforts alone. They allow for precise targeting, so your message reaches the specific people most likely to care. This can accelerate growth, drive sales, provide valuable audience and marketing data. When used correctly, a paid strategy is an invaluable tool for any business creator brand looking to expand their digital footprint in a crowded online world. However, paid accounts are not a magic wand. The myths surrounding them can lead to wasted money, damaged reputations, and immense frustration. Success is not guaranteed simply because you spend money. A paid strategy cannot fix bad content, a weak product, a non-existent brand message. It is an amplifier, not a creator. Think of it as a power drill. In the right hands, it can build something amazing, but without care, it can cause a lot of damage. Use it skillfully.